All right, everybody, here we go. All right, first, yesterday I didn't get it. Wait, before I get into that, let me just say I just sent out my weekly analysis of the EIA Petroleum Status Report that comes out every week. So look for that if you're on the list, if you'd like to get a copy of that. And by the way, there are a couple of interesting developments in the latest data. Number one, we saw a record level for U.S. crude oil exports, a record level 3.6 million barrels a day. That is a record. It was also the largest weekly increase on record. So that's very important. The other thing is we saw a very big rebound in crude oil imports. It's important because remember, Venezuelan imports got blocked because of the sanctions. The week before, we saw the lowest level of imports into the United States in 23 years, but it had a really big rebound. So those are two important things if you want to, and again, that weekly report, I know a lot of the zombies, a lot of people, they just wait for that to come out and they look at inventories and then they just reflexively trade based on the inventory numbers of crude oil. Maybe if they think they're smart, they're looking at gasoline and distillate, but there is a lot of information in that report. There's information on inventories, of course, we know that. There's information on demand for crude oil, for products. There's information on imports and exports. There's information on production. You got to know how to synthesize all that stuff, and that's what I do every week. If you want a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader or Zombie Trading. Zombie Trading, of course, is my daily Forex signal service. We front run the zombies because we know how they're going to behave. We take their money and we get out before they die. By the way, MMT Trader, the subscription rate will be going up to $250 a month, not for current subscribers. Your rate stays the same, but it'll be going up to $250 a month. March 1st, you could still lock in a rate of $195 a month, and it's cheap. Nobody does what I do. I have the only applied method of MMT, modern monetary theory, that exists. I take the concepts of MMT and I meld them, I put them together with trading strategies and mental game. That's the most important thing. I've spoken about that so many times. And that is why it is a unique system. Nobody else does what I do. All right, so I talked about that. Yesterday, I didn't have a chance to comment. It was either yesterday or the day before when the news report, maybe I did comment, I don't remember, but it was when the news reports, when was the minutes, FOMC minutes were released. There was now, or there is now, not even a belief, a firm, basically a conclusion that the Fed will stop balance sheet roll-off, in other words, the shrinking of its balance sheet by sometime this year. Goldman Sachs now says by the end of the third quarter. Now, you may recall back in January at the Fed meeting, what was it, January 30th, when that meeting concluded, I said, nobody else said this at the time, I said it sounded to me from Powell's remarks that they were ending, of course they paused on the rate hikes. I said also, I think they're going to end the roll-offs. Everyone said, no, that's going to continue. But that's basically the decision they came to at the time of the meeting. And that has implications. It has big implications. Short term and then in the big macro sense. I mean, that's very, very important. You have the pause in the rates and you have the end of balance sheet shrinkage. Very important. Now, that's not going to happen until the third quarter. At least that's the speculation right now. But really important. Changes the whole dynamic. All right. And let's talk about that too, because it's misnamed. People call it quantitative tightening. First of all, there's no such thing, let me just say this, there's no such thing as quantitative easing and quantitative tightening. Those are made up terms, all right? And they don't do, not only do they not do what people think they do, they're actually the opposite of what people think they do. And I've been talking about this many times in the past. Those operations, which are part of the toolbox of monetary operations that the Fed can employ, all they do is change the composition of financial assets that exist in the economy. They're basically asset swaps. Okay, I've been over this many times. When the Fed does so-called quantitative easing, all right, when it buys assets, it is buying, they are buying essentially treasury securities. That's what they like to buy. But they could buy any asset. It doesn't matter. I mean, they could assume bank loans. They could buy. It says right in the Federal Reserve Act that they could discount anything, meaning they could buy anything. But they usually buy treasury securities or mortgage-backed treasury and agency, mortgage-backed securities, etc. So they take away, and I've been through this, they take away those assets and they replace them with reserve balances, basically cash, which earn very little, in some cases zero. During the crisis, they earn zero. So it's an asset swap. It's a recomposition of the financial assets in the economy. For the Fed, reserves are liabilities. They are assets for banks and the economy. And so the Fed is taking away those treasuries, which are liabilities of the U.S. government. They're replacing it with other liabilities, which are their own liabilities. The economy gets a different composition of assets. And we know that when they buy the treasuries, which normally have a higher yield, a higher return, a higher interest payment than reserves, cash, they are removing that income. So it's not quantitative easing at all. And we saw this very clearly when the Fed was engaging in this, that interest income, personal interest income, which is a component of national income, went down significantly. All right, dropped something like 200 billion. And personal interest income is not an insignificant part of personal income. It's a fairly large component. Now, quantitative tightening, again, it's not a tightening. What is that? So the Fed is giving back those treasuries that it took away, right? It's letting those treasuries remain in the economy, and it's taking away the reserve balances, which are lower yielding, okay? So allowing those higher yielding assets to remain in the economy, they're earning more money. The money now is flowing into the economy from the as opposed to flowing to the Fed's pocketbook. So that's not a quantitative tightening. It's very, none of these things exist. These are made up terms. The only thing is an asset swap. The Fed can do just a limited number of things. It's a bank. It could make loans. It could change the composition of assets in the economy, right? The Fed has unlimited capacity to create reserves. It has limited capacity to sell assets. The Treasury can do that. The Treasury has unlimited capacity to do that. All right, so it could work, and when it works together with the Treasury, it could in an ongoing way. And that's the consolidated financial arm of the government. It could just change the composition of financial assets, dollar-denominated financial assets in the economy. That's it. And of course, it could set interest rates. And the interesting thing about setting interest rates, if you think about it, now that the Fed itself has to pay interest out of its own pocket, in other words, out of its own earnings. Now, that was Bernanke's idea, remember. Theoretically, there's a limit. We don't know, but theoretically, there could be a limit to how much interest the Fed can pay. If it has to actually pay out of its own earnings, if the amount of interest it has to pay exceeds its earnings, see, in the old way, before Bernanke asked for that authority in 2008, the Treasury used to pay interest, and that was unlimited. But now that the Fed has to pay interest out of its own earnings, we don't know. There could be an upper boundary to that. We don't know. We haven't gotten there. But it's an interesting question. So yeah, that's what's happening. We have a little correction ongoing in stocks. Everything looks good though. And maybe I'll be back later. Take care. Bye-bye.